Lots of Fed speak today. All of it hits as September's mixed jobs report adds some new uncertainty over whether the Fed will move ahead with the December rate cut. Joining us right now is Richard Fisher. He is the former Dallas Fed president, also a CNBC contributor. And Richard, we have talked so much about will they or won't they that it gets a little tiresome. But you see the action with the market yesterday, and it makes you realize that the market is kind of hinging to some extent on what the Fed does. How important do you think this will they or won't they question is for the stock market right now, or for the bond markets too?
Yeah, Becky, as I've always said, the Fed cares about the credit markets. They don't care about the equity markets directly. And I think the real issue here that so many people have been talking about is, will there be a divisive vote? Will we have 3 governors vote against Powell, or will the bankers argue the opposite? I think that's the real issue, to see what comes out of this meeting. And I think it's very important, Becky, to realize there's nothing new about this. 4 of the governors voted against Paul Volcker at one point at the instruction of President Reagan, who wanted lower interest rates. Volcker resisted. He nearly quit his job because of that. And Greenspan had the same thing. There were 2 governors and 1 bank president voted against him at one point. And as you know, with Bernanke, we had several votes where we had 3 people or 4 people, not 4 or 3. I was one of them that voted against Ben. And yet that carries the table, and what comes out is what's important. So there's an awful lot of focus on the Fed right here. The Fed is not responsible, in my view, for what's happening in the market. And if you want to go back and read some history, I'd suggest our viewers go back and read Kindleberger's book on panics and manias and the reactions to therefore. This is
we gotta get. Oh, go ahead,
separate
sir.
dynamic that I don't think the Fed really plays much of a role in. There's too much emphasis on this, Becky. This is a reaction to an extreme rally that's taken place. Remember, the S&P bottomed at 666 during the great financial crisis. Where is it now? It's over 6,000. So put things in perspective. And I think this is just a reaction to overpricing underlying value.
We had a guest who joined us earlier this morning who pointed out that despite the Fed's rate cuts, both in this most recent cycle and in the last cycle right before the election, it didn't really move things on the longer end of the Treasury market. Didn't really move. In fact, yields moved higher despite the Fed rate cuts. And I guess that's the big question, too, is just even how much power the Fed has over things that people would like to see done, like lower mortgage rates.
Yeah, Becky, Powell's actually talked about this, and Fed officials have talked about this for a very long time. It's questionable whether Fed funds really impact the 10-year Treasury. And as I've said to you and on this show many times, I'd be watching the Treasury auctions. The 10-year Treasury is still around 4% and has gone up and gone below it. But that's what's moving the markets, supply and demand. And I don't think the key interest rates that affect businesses who borrow further out on the yield curve are really affected by what happens with Fed funds. That is important to traders and to momentum guys and to algo guys. But as far as underlying business is concerned, the housing market, et cetera, Fed funds have a limited impact in terms of the way they move. It's determined by supply and demand, particularly for the 10-year Treasury. And as you said, they cut 150 basis points. Those rates have gone up, have not gone down.
So what would you do if you had a vote, Richard, at the FOMC?
I'd resign immediately. No, I don't know, Becky. So I would probably be arguing here. I would consider carefully 25 basis points. And I'm sort of on the fence as to what to do here. We don't have inflation down to the point where everybody would like to see it. At the same time, we know, and we'll hear this at the meeting from all the bank presidents, which is where the input's going to come on what's happening with the jobs market and inflation in their districts. Now that they don't have the data, the hard data, they're going to have to rely on the bank presidents to give the reports on what's happening in each Federal Reserve district. So I'd want to listen to that, Becky. And I'm sort of on the fence about 25 or 0.
But, Richard, how much impact do you think the Fed can have in this moment on jobs? I mean, it's an interesting thing because we have this dual mandate situation. But if you really hear what a lot of the businesses are saying about jobs, it doesn't feel like the switch is going to be pulled, or that the impact of an interest rate cut is actually going to have a meaningful impact in this case.
Yeah, I think you're right. Look, uncertainty is the enemy of decision making. Our businesses right now are very uncertain as to what's going to happen on several fronts. You just had discussion on tariffs. Come again, go, come again, go. This administration is very spastic the way they're dealing with these key economic issues. That creates uncertainty. And making decisions under conditions of uncertainty are difficult. When you do impose a tax or a cost factor, however big or however small, like tariffs, you have to look for ways to protect your margins. And one of the ways to protect your margins is to cut your costs. Labor is a critical cost. And so I do think companies, particularly the big ones we've seen, have been looking at how they can use enhanced technology, AI, et cetera, to protect their cost structure and also at the same time ramp up productivity. The only other option is to raise prices. We're seeing both take place at once. So I really don't think here, again, to repeat myself, that what the Fed does here impacts business decision making. If anything, they want to see a constant rhythm to the Fed because there's so much uncertainty everywhere else on fiscal policy, on economic policy, macroeconomic policy, and globally as well.